All right, let's jump right in. We're going to tackle one of the biggest, most nerve-wracking questions in all of finance, one that has been on investors' minds for more than a century.
I mean, it's the question we all ask ourselves, right? You're seeing the market just rip higher and higher, you hear all the buzz, but then that little voice in the back of your head starts whispering, is this it? Is this the top? It's a really tough call to make when you're in the thick of it.
So here's what we're going to do. We're going to travel back in time, basically, and follow along with a legendary investor who, back in 1972, sat down and analyzed 100 years of market history to answer this exact question. We're going to follow his investigation step by step.
Okay, so where does any good detective story start? You gather the evidence. And for us, the first piece of evidence is always history. Before we can even begin to judge if a market is high, we got to understand what its normal behavior even looks like.
And when you look at the data, one thing just jumps off the page. The market is a wild ride. We're not talking about little dips here. We're talking about huge declines, 40, 50%. And of course, the big one, that absolutely devastating 89% crash after 1929. The main takeaway here, these massive stomach-churning drops, they're not weird exceptions. They're a totally normal, recurring part of the deal.
So with all that chaos, what's the big picture? What's the point? Well, it's this. Even with all those gut-wrenching drops, the long-term trend has been, well, up. The market grows through these crazy cycles, not in some nice, neat, straight line. And that is the absolute bedrock idea we have to start with.
Right, but 100 years of data is a lot. It's just noise if you don't know how to look at it. A good detective, though, they look for patterns. And that's exactly what our analyst did. He broke down all this chaos into 3 really distinct eras of investing.
So, era number 1. This takes us from 1900 to about 1924. You can think of this as the market's boring phase, maybe. I mean, it had its ups and downs for sure, but they were pretty regular, and the growth was kind of slow and steady. We're talking about a 3% average price gain per year. Predictable, yeah, but not exactly setting the world on fire.
And then everything changed. Era 2, from 25 to 49, was just pure whiplash. You had the insane boom of the Roaring '20s, immediately followed by the Great Crash. This period was so extreme, it left these deep psychological scars on generations of investors. And get this, after all that drama, the average advance was a tiny 1.5% a year. You can see why the public was just completely turned off by stocks.
But then, right out of that period of total despair, comes the complete opposite. Era 3, from 1949 to 1968, was just wow. It was the greatest bull market in history up to that point, an absolute monster. We're talking about an 11% average price gain every single year for almost 20 years. And that's before you even count dividends. This completely changed the game and how people thought about making money.
Yeah, let's really hammer this home. Once you factor in the dividends, investors were getting total returns of over 14%, year after year. Now, this created a really powerful idea in people's minds. And this is what worried our analyst, a dangerous idea, that these incredible returns were just the new normal.
Okay, so we've looked at the history. We've seen the booms, the busts, the different eras. The evidence is on the table. Now, any good investigator needs the right tools to make sense of it all. So let's look at the simple but powerful metric our analysts used to figure out if the market was running too hot. And that tool is the price-to-earnings ratio, or PE for short. The easiest way to think about it is like a thermometer for the market. It just tells you how much people are willing to pay for $1 of a company's earnings. A low PE, that's like a cold market. Stocks are cheap. A high PE, that's a hot market. Things are getting expensive. But just knowing the temperature isn't enough. Is 80 degrees hot? Depends if you're in Alaska or the Sahara, right? You need context. And this is the context, and it shows an absolutely incredible reversal. Just think of yield as the income you get paid from an investment. Back in 1949, when the big bull market was just getting started, the income you got from stocks was way, way higher than what you could get from super safe government bonds. But by 1972, it had totally flipped on its head. Now, the safe bonds were paying you more than double what the risky stocks were.
And this chart just makes it impossible to ignore. Look at that. In 49, the stock yield bar is towering over the bond yield bar. Fast forward to 72, and the bond bar is more than double the stock bar. That extra money you're supposed to get for taking the risk of owning stocks, it had completely vanished. In fact, you were getting paid more to take less risk with bonds. For any careful investor, this was a giant flashing red light.
Okay, so we've got our history and we've got our tools. But the big question is, do these tools actually work in the real world? A good detective always checks their past cases, right? So let's see what our analyst had to say about the market at other points in time.
And when you look at his track record, a really clear pattern emerges. As the market just kept climbing and climbing through the 50s and 60s, his warnings got louder and louder. He went from being cautious to calling the market dangerous, to just flat out saying it was too high by 1964.
And this quote just says it all. You can really feel his frustration and his conviction here. He's basically throwing his hands up and saying, look, if the market in the mid-60s isn't too high, then what in the world is? How could we ever say any price is too high? The word would have no meaning.
All right, this is it, the moment of truth. We've looked at the history, we've examined the tools, we've reviewed the track record. It's time to bring all the evidence together and deliver the final verdict on the market as it stood in early 1972.
And here's the key takeaway, the real nugget of wisdom. The verdict wasn't based on just one thing. That PE ratio, our market thermometer, it actually wasn't screaming danger. It seemed pretty reasonable. But, and this is the big but, the relationship between what stocks were paying you and what safe bonds were paying you was historically awful. That huge imbalance is what made the whole market unattractive for a careful, prudent investor.
So, what do you do with that conclusion? Well, it led to some very clear, very practical advice. Step 1, do not borrow money to buy stocks. No margin debt. Step 2, stop putting new money into stocks for now. And step 3, if stocks are a huge part of your portfolio, trim them back. Get to a more conservative 50-50 split between stocks and bonds. This wasn't some wild call to sell everything and run for the hills. It was a calm, common-sense argument for playing defense.
And then we're going to end with this quote from Aristotle, which the analyst himself loved to use. It's such a profound reminder that investing isn't physics or math. We can't demand perfect, exact answers. The whole point of an analysis like this isn't to predict the future down to the last decimal point. It's to understand the present with discipline and reason. So the real question isn't just, is the market too high? The better question is, are you prepared for the wild range of outcomes that history shows us can and will happen?